Okay, so we're going to follow up on the last video. It's talking about tax breaks. So tax breaks and tax credits a little bit different, but a tax break is typically made available to stimulate the economy by increasing the amount of money taxpayers have to spend, which promotes certain types of behaviors, such as purchasing energy efficient appliances and attending college. So one of the tax breaks that you might get is if you install solar panels in your house or windows that are energy efficient, then you might get a tax break for that because it's stimulating. They want people to go green, I guess. That's certain types of behaviors. So the government gives certain tax breaks for these types of things. Another one is attending college. You get a tax break, a one-time tax break for attending college. Tax breaks, they can greatly reduce the taxpayer's liabilities. The taxpayer's liability comes directly off the amount of tax that they pay. So it can provide savings through tax deductions or tax credits. So tax deductions, they're expenses that the taxpayer incurs during the year which they can write off or take off of their income so that they don't pay taxes on that amount. So some of the things that you can take tax deductions for would be interest on your home. If you own a home and you have a loan on it and you're paying interest to the bank or mortgage company, you can take that interest off your taxes. If you pay property taxes, which if you own a home you have to, then you can take that off as a deduction. Charitable giving, anytime you give money to any charity, church, nonprofit organization, you can use that as a deduction too. A percentage of your medical bills you can take off as a deduction. So here is an example of how a deduction works. So the $75,000, his gross income is $75,000. It's a single tax filer, and he falls in the 22% tax bracket. So your 22% times $75,000, he's going to owe $16,500 in taxes. But he qualifies for an $8,000 tax deduction. So you subtract the $8,000 from the $75,000, and now he only owes $14,740. So deductions lowers the amount of income that is taxed. So a tax deduction lowers a person's tax liability by lowering the taxable income. So it varies at the federal and state level as to what you can deduct. We don't have state income tax, but tax deductions falls into two categories, either your standard deduction or itemized deduction. So you can only do one of these two things. So the standard deduction is a portion of income which is not subject to tax and can be used to reduce the tax bill. So a standard deduction is what everybody gets if they don't itemize. So it depends on what filing status you are. So if you're single, your standard deduction might be $8,000. If you're married filing jointly, it might be $12,000. So the government or the IRS sets the standard deduction each year, and it changes a little bit each year. It went up quite a bit last year. So the standard deduction is based on your filing status, your age, and whether you're disabled or claimed as a dependent on someone else's tax return. Most of you will take the standard deduction. Then itemized deductions are where you itemize all of your expenses that are that you can save tax on. So like for instance, charitable giving. Anytime you give money to charity, you can deduct that from your taxes. Any nonprofit organization that you give money to or give goods to. It doesn't have to necessarily be money, but you can donate furniture or clothes or whatever to Goodwill, and you can the amount or the value of that you can deduct from your taxes and itemize. interest on property that you own. You can, if you're paying interest on it or paying taxes, you can deduct that as well. So taxpayers are allowed, you can choose the standard deduction or the itemized deduction. You would want to choose whichever one is higher because that's going to benefit you the most. So itemized deductions is a little bit more complicated because you're going to have to use the longer form or the 1040 rather than the 1040A, which is an easier form to complete. So only a taxpayer eligible for the standard deduction can choose it. You have to be a U.S. citizen, and aliens who are residents for tax purposes are eligible to claim the standard deduction. Non-resident aliens are not. If a taxpayer is filing as married, filing separately, and his or her spouse itemizes, then the taxpayer cannot claim the standard deduction. So in other words, if you're married and you file separately, then only one of you can either itemize or take the standard deduction. You both can't. So if you itemize, you have to maintain records. So you have to have documents to back up what you're itemizing. So for instance, if you give money to the church, you need some documentation from the church showing how much you gave. In case you were to get audited, then you have that documentation to prove what you have itemized is correct. What deductions you've taken are legitimate. If the bank sends the amount of interest that you paid on your house loan, so you have that as documentation. Taxes, you can get that online. Any medical expenses that you're deducting, you need some documentation for that as well. So a tax credit is a tax break which reduces a taxpayer's tax liability and has greater impact than deductions. And the reason that it does is that deductions, a tax deduction comes off your income. So that you take your income and subtract the deduction, and then you're taxed on that income. But a tax credit is deducted from the amount of tax you owe. So it has a greater impact. It's more beneficial. Tax credits are more beneficial to the taxpayer. So here's an example. If an individual owes $3,000 to the government and is eligible for $1,100 tax credit, he or she only has to pay $1,900. So you subtract $1,100 from $3,000 and they only owe $1,900. So tax credit is the amount of money a taxpayer can subtract from taxes owed. So it just reduces the amount of tax owed. It's more favorable than a tax deduction or exemption because tax credits reduce tax liability dollar for dollar. So it's reducing it dollar for dollar, whereas a tax deduction, it's a percentage depending on what filing status, what tax bracket you're in. So tax credit is granted to individuals or businesses in specific locations, classifications, or industries. So, and like we said, it may be granted to promote specific behaviors, such as replacing older appliances with more efficient ones to help disadvantaged. So, tax credits, it could be, if you replace an appliance that is more energy efficient, you might get a tax credit. Farmers might get tax credits. Low-income people could get a tax credit. So it can be granted in several forms: non-refundable, refundable, and partially refundable. Non-refundable are items directly deducted from the tax liability until the tax liability equals zero. It negatively impacts low-income taxpayers as they are often unable to use the entire amount of the credit. So in other words, if you owe $1,000 in taxes and you have a $2,000 tax break, then it's going to lower your tax to zero, but the extra 1,000 of that 2,000 they don't give back to you. So it just lowers it to zero. So a non-refundable just lowers it to zero. Examples include benefits for adoption, raising children, earning foreign income, and paying mortgage interest. So earning foreign income would be if you're working overseas and they're giving you a tax credit because you're doing something that's going to benefit something in America. Then you might get income, foreign income, and that might be a tax credit. Adoption, you get a tax credit, but it's non-refundable, so it's only going to lower your tax to zero, if it's enough to lower it to zero. And then refundable tax credits are the most beneficial credits, as they are entirely refundable. So in other words, if a taxpayer's income or tax liability, he or she is entitled to the entire amount of the credit. So again, if your tax credit was $2,000 and you only owed $1,000 on taxes, then it would lower your bill to zero, and then the extra $1,000 they would give to you in a form of a check. So you would get the extra $1,000. Partially refundable tax credits, you might get part of it back and part of it not. If a taxpayer reduces his or her tax liability to zero before using the entire portion of the $2,500 tax deduction, the remainder may be taken as a refundable credit up to the lesser amount of 40% of the credit, or $1,000. So partially refundable just means that part of it you might get refunded back to you and part of it not. Charitable donations is gift made by an individual or organization to a nonprofit organization, commonly in the form of cash, like we said, but sometimes it could be, you could donate something that's not money, like property or clothes or electronics, and those things, the value of them you can deduct. So charitable donations, they can have great tax benefits. A gift to a qualified charitable organization may entitle a taxpayer to a charitable contribution deduction against their income tax if they itemize deductions. You have to take it in the year that it was paid, and most charitable organizations qualify to accept it as a tax deduction. So we're going to stop there on figuring taxes. This is just a step-by-step how to do it, but we're going to actually do a tax return next week, so we will go through that step by step.